The Global Liquidity Index has breakout patterns at regular intervals with a big impact on Bitcoin. So I performed a study. The Global Liquidity Index is made up of all the world's central bank balance sheets and M2 money supply and is a holistic measure of global macro liquidity. The chart of GLI was plotted in TradingView and searched for breakout patterns. For each pattern, a top line was drawn connecting the first and second local maxima, and a bottom line was drawn connecting the first and second local minima. The beginning of each pattern was taken as the first local maximum, and the end of the pattern was taken as the intersection of the top and bottom lines. The breakout point is the first close above the top line of each pattern. Five total breakout patterns were observed during the period following the beginning of 2008. The election cycle years are overlaid on the chart for reference, along with the Bitcoin log chart and topping events. Data for each GLI breakout pattern is recorded in the following table. Looking at the TradingView chart of the Global Liquidity Index, we can see that the breakout patterns occur at regular intervals, roughly every 4 years, into or during the election year, followed by the Bitcoin peak. The data in the table shows the breakout length as a percentage of the length of the total pattern. We can see that the length of the patterns is increasing over time, and that the average length to the breakout in terms of the total length is roughly 88%. The actual average there is 88.4%. And if we have a look closely at the Bitcoin topping events, we can see that generally there's a rough relationship between the two where generally speaking it will happen, but there's a fairly large variance between the time of the liquidity breakout and the actual peak for Bitcoin. You can see there that it's roughly 30% variability on the mean. If the standard deviation is fairly large in comparison to it. And so we can maybe partially explain that variability with the slope. I went ahead and performed a best fit analysis, looking at the starting point for each of these patterns and the length of the pattern, and then performed a linear regression. It does appear as though that the fit is quite good at 0.96 for R there. If we use the projection to have a look into the future, assuming that the recent high in liquidity was actually the beginning of the new pattern on February 15th or so, then projecting ahead, it would predict here that we would see the next breakout event for liquidity sometime in October of 2028. Some possible explanations for the behavior that we're seeing are one, technical patterns like triangles will typically break out about 80% into the length of the pattern, regardless of the time frame. Just simply, that's the way the fractal patterns on these charts a lot of times will work. Two, many corporations and world governments' funding cycles are synchronized to the Federal Reserve Bank and U.S. Fed policy, and these tend to coincide with the election cycle. So that's one reason why we see them in regular intervals, and that they coincide with the Bitcoin peaks, roughly speaking. Three, linear progression in pattern length reflects the increasing scale of money printing and resulting instability due to excessive leverage. Generalized leverage in the system would create sort of a larger scale leverage crush, which is maybe one of the reasons why we're seeing so many assets, especially risk assets, be so volatile. Four, the highly variable distance to the next Bitcoin top may reflect the variability in the rate of liquidity production following breakouts, with slower release corresponding to shorter distances to the top. So, like if you have liquidity being released at a slower rate, then probably less of it would be flowing to Bitcoin, and it would maybe cause the peak to be sooner. And if you had a lot of liquidity released, then Bitcoin may have a little longer to go. At least that's the hypothesis. Now, if we like flip over to the chart again, we can kind of see that the longer periods of time that we have between the breakout of the pattern and and the actual top of Bitcoin, it does appear as though the bigger the slope, the steeper the slope of the M2, the longer the time it is until Bitcoin actually peaks. And we see that fairly fairly consistently here. We had very shallow release, and so a very short time to the peak there. We had a very steep release and a longer time, between the breakout and the actual peak for Bitcoin. Um, so that's sort of one explanation for why we might see that variability in the distance to the peak for Bitcoin. Some avenues for further study could be impact of global liquidity breakouts on market broadening events. So, how do equities expand into, say, lower market cap single stocks and things like that at different parts of this liquidity cycle following a breakout. And then another avenue of research could be behavior of major stock indices relative to the liquidity breakouts. We see the liquidity responsiveness for Bitcoin being quite exaggerated, but other indices, um, in the traditional markets, like ones for semiconductors, like SMH, is also especially volatile. But the broad index, like SPX, would also be responsive. So studying that behavior could be insightful as well. Anyway, this has been the liquidity breakout study, not financial advice. Do your own research.